The International Monetary Fund (IMF) in its latest report has urged Nigeria and other emerging markets with stronger inflation pressures or weaker institutions to swiftly depreciate their currencies and raise benchmark interest rates. The Bretton Woods institution disclosed this, that while the challenges in the global economic outlook appears positive, especially in the United States, these changes are uncertain for emerging markets, adding that countries with high level of debt dominated in foreign currencies should look to urge their exposures where feasible. Well, it will interest you to know that Nigerian currency in the last 9 years have been devalued, with the most recent in December 2021, which saw the Naira close to 435 Naira to a dollar. Now, however, economic experts are of the view that if IMF's advice is taken, a further devaluation of the Naira will plunge Nigeria into deeper poverty and higher inflation rates. To give more insights into this report and understand it, of course, some burning economic issues raised in this very important report, I have joining us now live from our Abuja studios. He is the president of the Capital Market Academics of Nigeria, as well as the professor, Capital Market, Nasarawa State University, Professor Uche Waleke. Good afternoon, and it's good to see you this new year, Professor Waleke.
Yeah, thanks very much, Tolu. Happy New Year. This is my first time on the program this year. It's indeed my pleasure.
All right. Prof, IMF is at it again. And this is, can I say, for the upton time, telling us that we need to devalue our currency and raise interest rates. First is, how would you react to this? Because a lot of reactions have actually trailed this, and they've been saying this for some time. Likewise, removal of subsidies on PMS and electricity.
Yeah, thanks, Tolu. But it's important I also correct an impression. I don't think that's that was an official IMF statement. It was something that appeared in the blog site and an IMF blog, which essentially was an opinion of some authors, maybe staff of the fund. I think the article was written by one Stephen Dunn and et al. So I think it was just their opinion, advising emerging markets, emerging economies. So I don't think that was an official statement, by the fund. Of course, the official one is being expected. I've not read yet the Article 4 consultation, report on Nigeria by the executive directors of IMF. But be that as it may, it's also good to note that the article or the opinion of these gentlemen usually reflects what you get normally, in the Article 4 consultation. And all that they have said is that emerging markets, emerging economies should, begin to prepare ahead of the plan by the Federal Reserve in the U.S. to tighten monetary policy. A case of, if the U.S. is sneezing, the rest of the world is catching cold. As you know, Tolu, the Federal Reserve, I think last month issued some sort of guidance on monetary policy plans to increase, borrowing costs. As we speak, the benchmark interest rate in the U.S. is known as the Fed fund rate. Fed fund rate target is between 0 and 0.25%, which is very low, and the Federal Reserve in the U.S. is thinking of increasing that, or if you like, the term used is normalizing interest rate because of the rising inflation that we now find happening in the U.S. For the Federal Reserve in the U.S., the target inflation rate is 2%, but as we speak, inflation rate in the U.S. has gone way higher than 6%. As a matter of fact, in 2021, it came in at 6.8%. the highest since 1982, as reported by the Bureau of Labor Statistics. So against that backdrop, because inflation rate is rising on the back of wage increases on the demand side, and on the supply side, supply disruptions, on account of the Omicron, virus, the variant of the COVID-19. So the Federal Reserve Chair, Jerome Powell, thinking of, increasing rates. And usually when that happens, what you find happening is that yields in the U.S. will rise, and if yields in the U.S. rise, you now find investors migrating to U.S. So you find a situation in which you have this capital outflows from emerging economies, emerging markets, including frontier markets, to developed countries. It's not only U.S. that is thinking of that, even in UK and including Japan, they're also thinking of normalizing interest rates. And part of what the Federal Reserve is thinking of doing by way of tightening monetary policy is also to slow down on asset purchases, their asset purchase program. The guidance I saw was talking about tapering the asset purchase program in the U.S. And what that means is, the U.S. will now, the Federal Reserve will reduce the rate at which money is pumped into, the economy. Of course, that will raise interest rates. And if that happens, as I said earlier on, you find the investors already in frontier markets or emerging markets now migrating to U.S. because of higher yields. So that's why that report was advising, or that opinion was advising, that emerging markets should also think of how to increase rates, because if you don't increase your rates, you don't make them attractive, those investors will leave, and you have this capital outflow. So to that extent, I agree that we should also be thinking of doing that. And it is something that is bound to happen in 2022. I see the Central Bank of Nigeria further tightening monetary policy. In anticipation of that, the Federal Reserve action, one, and secondly, to reduce the pressure that we are also going to witness in the Forex market in 2022, which we know is penultimate election year with associated, increase in demand for dollars. And of course, again, to also prepare ahead of some reforms that the government is thinking of, implementing in 2022, talking about fuel subsidy removal, and so on. So, in that respect, yes, I agree that interest rates, could be tinkered with to at least make investments in Nigeria a lot more attractive. The other suggestions, of course, by the authors. The authors talked about, on the fiscal side, they made some recommendations which I agree. They talked about public spending efficiency, which is critical, and gladly, the government of Nigeria is also, working towards that. Already, if you look at the 2022 budget, the strategic revenue growth initiatives there, you find the government talking about also growing revenue, because that report also advised economists, emerging markets to also grow their revenues by, possibly, looking at taxes to grow revenues. So if you look at our strategic revenue growth initiative, that has been also taken care of, including the issue of public spending efficiency. They also talked about reforms, subsidy reforms, and pension reforms. And the good thing is that we're already implementing pension reforms, contributing pension reforms in Nigeria. That's on the fiscal side. On the monetary side, Tolu, the interest rate, I said yes, that's bound to happen. I see the Central Bank of Nigeria increasing the monetary policy rate. If it doesn't, of course, it's not going to happen this January, because usually January, I don't expect the Monetary Policy Committee to touch the rates. But if it doesn't happen in March, it will happen in May when they meet. As I said, it's bound to happen. But on the burning issue of devaluation, Tolu, the report didn't talk about devaluation as a matter of fact. There is nowhere devaluation was mentioned. But they advised that central banks should allow the currency to depreciate. Of course, at the I&E window, investors and exporters window, you could say market forces are at play there. So that the advice is that central banks should not, intervene, especially those of them with insufficient, forex reserves. I think that report was, the article was clear on that. But on the issue of devaluation, whether the country should devalue, number one, the report didn't talk about it. But if you ask my opinion, I think it's one issue that we shouldn't, think of at this point in time. We shouldn't be talking about devaluing the Naira again, because if you look at recent history, we have done that over and over, and yet the problem is still there. So you don't do something over and over and expect to get a different, result. That's not the solution to the forex crisis where, in quotes, we're having. It's not devaluation. If you devalue, one of the consequences, the immediate consequence, the first victim of that will be the 2022 budget of the federal government and even that of the states that have already used 410 naira to the dollar as a benchmark. That will be the first victim, because it will make nonsense of all those plans. And of course, too, oil price is rising in the international oil markets. We just showed it here, at over $80 per barrel. And what it means is that the cost of importing fuel will continue to grow. And if the cost of importing fuel is high and you now devalue, Tolu, you can imagine what will happen. That's on the one side. On the other side too, look at the figure you showed too with respect to debt, public debt. Public debt today is in excess of 36 trillion. And that's because the foreign component has been converted using 410, more like the official exchange rate. Okay, if you now devalue this currency, you now make, the cost of servicing your debt in Naira terms, quite expensive. So that is the issue. We can't be talking about devaluation at this time, at least not when you have external reserves in excess of $40 billion.
Prof, very, very brilliant insight into this topic, and I really appreciate that. But I want to follow up with partly on the issue of Forex, because this report also, let's just pick the issues in the report, like you said, because we expect the IMF to release a fresh global economic forecast by January 25th. Yes, I think we are officially expecting that. But like you said, debt denominated in foreign currencies, and this report also saying they should look to hedge their exposures where feasible. The issue of demand and supply is what some economists are talking about at this time. They say we could have a spike, but it would always return to normal. What do you think if we have to do that with regards to our Naira?
Yeah, Tolu, the audio is lost. I didn't get what you said.
Oh, Prof.
Maybe I wait until it is fixed. But if you can hear me.
Oh, Prof. Hello, Prof.
Yes, I didn't get the question because the audio.
Professor Waleke, can you hear me now? I don't think yes. Professor Waleke. You can hear me?
Okay.
I asked you, I said, do you think, if you can hear me, do you
yes,
think,
I can hear you.
Do you think that adopting the demand and supply
yes.
scheme or, to our Forex issue, do you think that will help address these issues, considering the fact that our debt is denominated in foreign currencies, some of our debt?
Yes, of course, you know that the central bank has been trying to manage the demand side using some demand management strategies, one of which is this restriction it has with respect to certain products assessing Forex. Of course, you know that policy has been unpopular, but of course, I would say to a large extent effective in reducing the demand for the dollars, or in reducing the pressure we are having in the forex market. The central bank too has on the supply side tried to introduce some measures to encourage diaspora remittances, one of which is the Naira for dollar policy, which the central bank introduced last year. So I think on the part of the central bank, the much the central bank can do is largely what it's doing. The fundamental issue has to be do with supply. This is a country, unfortunately, that relies on one source of forex. Over 90% of our forex, comes from oil, and that is where the challenge is. So until we diversify our export base, the challenge will continue to be there. So even if you devalue today, to say to even match the parallel market rate of 560 or 570, okay, what happens? The parallel market will also shift, because it will never be this. It can never be the same. So you now find yourself in an unending journey of devaluation, because you have not fixed the fundamental issue, or the fundamental problem, which is supply. I was looking at the movement in foreign reserves, recently. The latest on the central bank website is that of 10th of January 2022. Okay, gross reserves as at 10th of January was about $40.5 billion. Now, on 1st of December 2021, it was $41.2 billion. So between 1st of December and 10th of January, it has dropped by over $700 million. And yet, this is a period that ordinarily you should expect the pressure in the forex market to reduce as a result of expected increase in diaspora remittances. People who are coming home, or who are remitting money home as a result of the festive season. So one had expected that would have reduced the pressure, such that the central bank would have intervened less, in the market. But that didn't happen. So that will tell you that we have a major problem. And one of that major problem has to do with, apart from the supply, on the demand side, this issue of fuel imports. We spend over 30% of forex importing fuel. So until that is tackled, you are still going to have this problem. So even if you devalue, you don't solve the problem by devaluation. The exchange rate, that we have today, even at the level where it is, it should be high enough to incentivize diaspora remittances, to incentivize any inflow that is coming. Because people say if you devalue, you make diaspora remittances more attractive. But it's the way it is high enough. So if we are not seeing that impact on the exchange rate, that will tell you that the problem is beyond. It goes beyond just mere devaluation. It won't achieve any purpose. So devaluing the currency at this time will be counterproductive. It will cause a lot of distortions in the economy. I've told you about what it will do with respect to budgets, both state and national. So what we need to do really is to also see how we can curb demand. If you look at the budget, for example, you ask yourself, the capital component is over 5 trillion of the budget, and then what is the foreign component of that capital component? Okay, so if we're making budgets, we'll also try to see that the foreign component of it is small. Take, for example, housing. If you're doing a budget for housing, okay, what type of materials are you sourcing for the houses you want to build? Okay, are they local? If they're local, of course, that will help forex. But if you're going to import them, of course, that will exert pressure on forex. So both at the federal and the state level, okay, we should try as much as possible to implement this local content thing, because that is what will save the Naira. So the fiscal authorities have a lot of role to play in firming up the Naira. It's not about the central bank, really, because the central bank has little to do. Yes, it is their responsibility to manage the exchange rate, but again, they can't do that if you are having some fiscal actions that are at variance with a strong domestic currency. If I still have the time, maybe I should also say this. You ask yourself, Tolu, of what purpose will devaluation serve this country? Okay, is it going to improve our balance of payment? It is doubtful. Is it going to improve our current account balances? That is doubtful. And that is because we export just oil. We import so much and we export just oil. So even if you devalue with the intention of encouraging exports, that may not happen. But of course, if you recommend that to some other emerging economies, for example, in that article, the article mentioned Brazil, mentioned Russia, mentioned South Africa. In that, Nigeria was not even mentioned. So if you recommend that to some of these other countries that are export-oriented, that would make sense. But for Nigeria, that unfortunately is an import-dependent economy, is a net importing country, that will not work. So I don't support devaluation of the Naira, at this time.
Now, Prof, finally, Omicron has raised additional concerns of supply-side inflation. What do you think would shape up the report of the IMF that we expect by the end of the month?
Yes, in that article, I think the authors were also somewhat optimistic that the Omicron challenge, would peter out, over time, and if that happens, that the rate at which the Federal Reserve of the U.S., the rate at which they may implement the interest rate normalization plan, may be slowed. And again, where that happens, I don't expect the spillover of that on emerging markets to be, so remarkable or dramatic. Yes, the Omicron variant is there, but it is good to note that it does appear the world is rising up to the challenge. For now, as we speak, it's not having any major impact on the world economy. Look at oil price, for example. Oil price is still, doing well. And if you go by the estimates, forecasts of reputable energy agencies, including the Energy Information Administration, including the World Bank itself, you would find that none of them is estimating or forecasting any oil price below $60 per barrel for 2022, and already our below $70 per barrel rather, and our budget is based on $62 per barrel. So I think to that extent we are safe. Even the World Bank just recently revised upwards its growth forecast for Nigeria for 2022, including the IMF. Even though those forecasts are still way below what the Nigerian government thinks we could do. That's 4.2% by the government's 2022 budget for 2022. So I think going forward, what we're required to do is to continue to have this strong handshake between the monetary authorities and the fiscal authorities, to ensure that any negative impact of global events, or global risks are contained or mitigated, and they don't affect our economy adversely.
Thank you so much. I've been speaking to President of the Capital Market Academics of Nigeria, as well as a Professor, Capital Market, National State University, Professor Uche Uwaleke. Thank you so much for making us understand all of this, at least breaking down that very important report. Do enjoy the rest of your day.